United States backed off of what were extremely imprudent and potentially economically very damaging prohibitive tariffs to the point of embargo on China. That was a good thing for the U.S. economy.
Goldman Sachs just flipped on their recession call, though people are now worried about the tariff midterm, which markets aren't really pricing in right now. Geopolitics are progressing awfully slowly, and progressing might be a generous word. We're going to look at the United Health financials, and we're actually going to show what HouseHack does in this video because maybe we haven't explained that super clearly. So we're going to do a really cool before and after in this video, and I think you'll love it. But anyway, let's get started with the recession is canceled. So per Goldman Sachs, the significant reprieve that tariffs have provided are a, quote, more significant de-escalation than widely expected. We'll go ahead and show you this on screen here. This is directly from their institutional piece. In the US, we raised our growth forecast this year to just 1%, up from a 0.5% forecast Q4 to Q4, lowered our year-end unemployment rate forecast to 4.5% from 4.7%, and reduced our 12-month recession odds to 35% from 45%. Now, statistically, most of these, research shops have about a 20 to 15% ongoing recession risk every single year. They're really just taking sort of the historical time frames that you'll see a recession divided by the number of years, basic. So 35% represents really only a slightly elevated risk to reflect tariff developments and meaningful easing in financial conditions over the past month. Now, if financial conditions are not only credit spreads, which have narrowed, but also stock prices, which obviously have gone up. Both of those are an easing of financial conditions, though the most traditional easing of financial conditions that we think of are bond yields. And bond yields have obviously gone nothing but up. And honestly, with this Moody's downgrade, I don't really know that risk assets are going to care, because every time it's happened in the past, it's just been a buy the dip opportunity. And this market right now, it's like if there's a switch that's like, do we buy the dip or do we not buy the dip? The switch is on, we buy the dip. Okay, so the market, I don't think is really gonna give a flying hooties. I think people are calling for this Black Monday or whatever. I don't know. Could it trigger stop losses if you have a big red candle at the beginning of the day on Monday? Maybe, but I think it's relatively overblown. I'll tell you what I'm more worried about in just a moment, and frankly, even that isn't that big of a deal, but it could be. So we'll talk about that in just a moment. Goldman Sachs thinks that the Fed is going to begin a series of 3 rate cuts in December. So basically, they think the Fed's going to delay their first cut all the way until December, and then they'll cut every other meeting by 25 basis points, which is pretty paltry and very, very slow. But honestly, if the unemployment rate only rises to 4.5 by the end of the year, which would be like 0.2, 0.3, depending on, from which time frame you start counting, maybe. The biggest thing that would really get the Fed to rush to zero would be a rise in unemployment. But that hasn't happened yet. And whether it does happen over the next 2 or 3 months is anybody's guess. I'm also guessing that there's a high likelihood businesses try to retain employees just a bit longer here to see, hey, are consumers going to come back to spending from that slowdown we saw in April? Retail sales got hit obviously dramatically. And let's see, if we end up with continued spending, who cares? You don't have to lay people off. So we'll know that by like August or September. Anyway, they say we recently upgraded equities from underweight to neutral in our 3-month asset allocation. That said, we think asymmetry for equity investing is still quite poor, partly as the market remains vulnerable to a recessionary outcome after the recent relief rally. In other words, if we do have a recession, markets are pricing in basically no protection. I completely agree with that. Markets have basically pretended like tariffs don't exist anymore. And Goldman actually has a pretty good chart showing us, tariffs definitely still exist, and we're definitely at a higher level than where we were. But when you look at tariffs sort of broadly, here, we'll put a little line across it, it kind of feels like tariffs don't exist. You know how like when you look at COVID charts sometimes, because there's like the huge spike, it makes the like end result look so meaningfully insignificant that it doesn't matter. You almost have to like zoom away from this. But just look at this, for example. Let's take the China effective tariff rate on the U.S. and we'll sort of draw this green line right about here. There, what is that? Whatever that is. And then if we go ahead and draw another line here, and then we kind of look at where things sit now, we could see there's this meaningful gap. According to Goldman here, what is that? 15-ish to maybe 30%. So a doubling in the effective tariff rate. Based on how they are calculating the effective tariff rate, most see the effective trade weighted, so based on what we actually trade, tariff rates at about 15 times larger than what they were before. So that gap, that's going from like 2% to 30%. That gap is still meaningful, but nobody knows what kind of damage this is going to cause. But I agree with Goldman that, if the unemployment rate moves that little, yeah, you probably should expect pretty slow movements in Fed yield, rate positions, basically. Now, that said, they say, hey, maybe this doesn't bode well for the future of stock prices. I think it's a little too soon to say that. There are a few charts that I like looking at. Here's a chart called the excess cape yield. And basically what it does is it takes cyclically adjusted earnings. So, they try to smooth out the seasons and the cycle, whatever. And what are our earnings doing? And how much is the S&P 500 returning in excess of inflation? So this is basically an inflation-adjusted earnings set based on where we sit in cycles and seasons. That's like the easiest way to try to put it. And I know I'm way oversimplifying. Well, that level sits at about 2.8%. And if you look at sort of history, 2.8% is pretty low. It puts us somewhere around that 2018 level, the 2006 and 7 level over here. Obviously, things got a whole lot less desirable in the dot-com era, but it shows you how significantly negative this chart got in the dot-com era, and we just haven't seen that here, which is actually kind of bullish if you think about it, because we frequently compare back to the 2000s and the overvalued nature of the stock market, how, there's some parallels between 2001 to 2003 and today. But when you look at the excess cape yield, that actually went negative at a certain point in the dot-com era. And this is historically how markets react after, the next 10 years. And then they look at the rate of return that you can expect on stocks every year for the next 10 years. When your excess cape yield is between 1% to 5%, you might think the S&P 500, historically, since 1928, would return somewhere around 1% to 5%. So given that we're somewhere in the middle of this range, maybe we'll return somewhere in the middle of that, 2.5% per year over the next 10 years. Basically, soft landing style growth, smooth, recovery out of this disaster, but no crazy boom. But we don't have an excess cape yield, so we wouldn't be expecting negative returns. That's at least based on this one chart. Obviously, if you now factor in things like AI or radically growing growth estimates for some of the largest companies in America, and if consumption holds up, then this could be wrong and we could return a whole lot more than this in the stock market. So it's kind of interesting to look at it that way. Now, personally, people always ask, Kevin, where are you on the bear bull scale? Once we got the May 12th deal, I moved from a 2.9 to a 3.4. So I'm still more on the bearish side. And I'd say by August, September, we'll have enough data to feel comfortable that we're not going to have some surge of unemployment and some unemployment-driven recession. That is the worst case scenario for markets, and it's very painful to a lot of people. I hope that doesn't happen. Obviously, if that does happen, like we heard Jay Powell say yesterday, we're going back to zero. That will cause its own distortions and problems. Besant this morning said that the Moody's downgrade is a lagging indicator. It's Biden's spending fault. Walmart's going to eat some of the tariffs, kind of doubling down on what we heard yesterday. And that if countries are not negotiating in good faith, then they'll just get assigned a tariff rate, basically. Now, this is interesting because that tariff rate could be above the sort of global 10% reciprocal tariff we have on every country now. And it remains to be seen what impact that's actually going to have. We're also 45 days already. Can you believe this? We're 45 days into the Liberation Day pause, which is kind of crazy to think about. It's maybe closer to 40 days, but we're coming up on 45 days into the Liberation Day pause. And tariffs are still 5x on the entire world what they were before liberation, 15x on China. And so keep in mind, the 30% on China is in addition to some of the older 2018 tariffs. So, some importers are paying 40 to 57% on tariffs to import from China. But some of those tariffs we already knew of beforehand. And right now, there are no current plans for more talks with China. So a lot of people are kind of like, all right, where does the world settle? And that's the thing. Nobody really knows. Maybe we just absorb it. Maybe importers just absorb it and wholesalers. Bloomberg says that most of the tariff impact so far has been absorbed by the U.S. side, not by consumers, but on that importer wholesaler level. And they measure the changes that they're seeing in sort of PPI versus expectations. And they're like, okay, yeah, we're basically paying all of the tariffs ourselves right now. That's their POV. Who knows? I'm sure other countries get hit in lower production as well. But anyway, we'll see. At the same time, there are also concerns that there are delays in China sort of reactivating approvals for rare earth exports. And China basically dominates this market. There are a couple charts that are worth looking at. And this is a chart of China's dominance by different rare earth, which are obviously very important for things like windmills, which Donald Trump hates anyway, or electric vehicles, which Donald Trump doesn't really like either, unless it's a Tesla. Whatever, also important for certain computing components. But here are various, and certainly machinery and otherwise, but here are various components or minerals, if you will, that and the blue bar shows you China's dominance. I'm not exactly sure why they made Canada roughly the same blue color as China, but let's just put it this way. The blue bar that you see is mostly China. And on top of that, if you take a peek at this chart here, China mines 70% of rare earth concentrates. This is basically a way of saying they pick up scoops of dirt and then they look for the rare earths inside of that scoop of dirt. They process 87% and refine 91%. So basically, they dominate. What impacts that'll have, who knows? So basically, we're in a big old wait and see for the economy. The market is like, we don't need to wait and see, everything is fine. So market, everything is fine. Market probably going to look through the Moody's crap. I mean, Bitcoin's at 105,000. That's one potential leading indicator for you, which is bullish. And the bond market's going to be pissed about the Moody's downgrade. But then again, the problem is, how much is that 10-2 yield spread going to rise now? Don't know. We'll see. And does that, again, leave us sensitive to a shock? Again, who knows? So, absent shock risk, market's happy. And this is where I've been saying, hey, if you're worried about shock risk, the easiest thing to have is a trailing stop. But I will say, if we get some form of red candlesticks on Monday morning, you have to be careful with the trailing stops because you could get stopped out and then people go buy the dip like crazy. So there's a little bit of a risk to the trailing stop on Monday because really we don't know what the reaction is going to be from institutions. Again, historically we get red, but we'll see. Okay, now let's talk Lyft and Tesla. Now I didn't actually mention that in the teaser, but we got to talk Lyft and Tesla. Lyft and Tesla have a partnership where Lyft and Tesla together will offer $1,000 in Tesla credits to you if you take delivery of a Tesla and you complete 100 Lyft trips through July 13th. It's basically a $10 bonus per trip, but it's in, Tesla credits. So you can buy Tesla merch or supercharging money, credits basically, whatever. What I'd like to do is think about how critical this partnership is, though. About a week ago, when I went to Alcatraz with Jack, shout out to Meet Jack Alcatraz. You could see his Alcatraz tour on YouTube. He threw a sound effect in there. Tell me when you find where the sound effect is. But on the trip over there, I talked about how Tesla would be wise to buy Lyft. And the reason I thought this is not because Tesla can't make an app themselves. I know they can. They do fantastic work with their technology. But it's a $7 billion company that I think Tesla can absorb without any even notice to the overall valuation of Tesla. Like you could absorb all of Lyft with stock from Tesla, and I don't even think Tesla stock would react. The benefit that you get is distribution. But maybe you don't have to buy Lyft if Lyft is already in good partnership with Tesla. Because the competition aspect is what you're most worried about when it comes to robotaxis. Waymo's got a really reputable app, and you might hate Waymo's. You might say Elon says Waymo's are Waymo expensive to build, and that's fine. But they have the app with excellent reviews and excellent reactiveness. Like when people go to San Francisco, they pull out the app. Oh yeah, I'm gonna just call a Waymo. Or people's reaction to pull out a Lyft or an Uber. That reaction momentum is what is going to be the hardest for Tesla to get. And that's why I say either partnering with Lyft, which they're already doing, is a wonderful thing for Tesla. It's actually bullish. If they just buy all of Lyft, they guaranteed have that distribution where people already open up their phone, call Lyft on an app, right? Except now a Tesla robotaxi can show up. That is, of course, to the extent that robotaxis are actually close. Who knows? We're coming up to June 1st. We'll see what Tesla has for us in their Austin partnership. I kind of want to go to Austin and try it out. I think it'd be kind of cool. But I'm sure every other creator on the platform is going to be doing the same thing. Either way, I see this as positive Lyft Tesla, that maybe Tesla doesn't even have to buy them. You've already got a built-in partnership. All right. Now, catalysts for this week coming up, not much. Leading index on for April, based on April's data, nobody cares. Okay, any data sets that are coming before May 12th, nobody cares. Chicago Fed activity for April, nobody cares. Initial claims Thursday, nobody cares. S&P Global Composite, Manufacturing, and Service PMIs preliminary for May. That comes out Thursday at 6:45. Maybe we'll care a little bit, but I don't think we're going to care that much because most of it is going to be pre-May 12th. Make sure to stay for the end of the video, by the way, because I'm going to reveal the multi-million to, in the future, if we build out the reputation, billion-dollar opportunities that HouseHack is working on. Stay tuned for the end of the video, and remember, our non-accredited investor round is open at househack.com. You get paid a 5% yield through stock conversion, and then you get all the upside in the stock from there. Go check it out at househack.com. Of course, risk with every investment, but I'm really excited about it, and watch towards the end of the video. All right, now let's talk geopolitics. Israel is launching an extensive ground operation in the Gaza Strip. Apparently, another 135 are dead in the Gaza Strip. All public hospitals in northern Gaza are out of service, and there's really concern over aid flow going into the Gaza Strip. But that has been true since October 7th, 2023. There have been fears of famine, illness, death, closed hospitals since then. The Egyptian president, al-Sisi, echoes this. UNICEF echoes this. Everybody's basically echoing, this is a problem. Now, obviously, the Trump administration and Israel have seemed very close, but Trump is playing a unique balance with this, with now headlines that Trump shrugged off Bibi Netanyahu at a golf course over the weekend. And people are like, what's going on? Who knows? But what we do know with certainty is J.D. Vance shook Zelensky's hand after the Oval first meeting since the Oval Office spat. Now here at the inauguration of the Pope. And remember the last person's hand J.D. Vance shook? Okay, I don't know. Maybe this is all part of the bigger plot. Okay, I'm kidding, but J.D. Vance did shake Zelensky's hand, so let's wait and see. Trump also suggests that he's going to talk to Putin and Zelensky, but we have to be really clear when it comes to Putin. Putin does not seem dead set on wanting a deal. And I think Trump is slowly warming up to that realization. And I think that's why they're sort of warming up to Zelensky a little bit more than Putin, because Putin just isn't bending. The interest in Putin getting this deal done seems to be roughly zero. That is some form of permanent ceasefire. However, there are cracks forming inside of Russia. Russia's military spending has spiraled out of control, as some are saying. Some others are saying, no, they're just reinventing their industrial economy to be a military industrial economy. Their defense spending has doubled to about $149 billion in 2024. That was from like the $60 billions in 2021. Worth noting, by the way, that Russia right now spends somewhere around 32.5% of their entire federal budget on the military. In the United States, we spend about 13% on the military. So huge difference here in terms of spending. I mean, they're spending almost 3 times as much as a percentage of their federal budget on the military. Russia's apparently having to pay North Korea in excess of $20 billion for services, basically to get, recruits to come fight for Russia. And the economy is facing significant worker shortages across various different portions of the Russian economy. So a lot of people are like, hey, maybe Putin will finally wake up to the damage he's causing. Others are like, nah. Ukraine is part of his legacy, and he's going to keep fighting until he gets more and more and more. We'll see. Let's now talk about United Health. United Health stock is down 42% year to date, over 44% over the last 12 months. Their Q1 balance sheet, let's just put it this way, it's not that desirable. I was actually surprised that a Dow 30 company does not have that desirable of a balance sheet. Take a look at this, and I'll hide myself so I don't cover up numbers here. All right, so on a liquid basis, they have $96 billion in current assets. But they have about $113 billion of bills to pay, which is a lot. They have to pay those bills over the next 12 months. Now, the company does generate about $20 billion of cash flow if you annualize out their Q1 2025 cash flow of about $5 billion, which means they would have just enough money to pay all of their bills. And so if you subtract their longer-term debts from their longer-term assets, they've got about $100 billion sitting around. So it kind of gives you the tangible value of this company. So think about it as they have net equity of $100 billion and they generate around $20 billion a year in cash flow, again, annualizing their Q1. They actually make a lot of money in that sense. So on their net equity, they're returning like 20% per year, which is phenomenal. Now, you are paying a premium for that business. Right now, you're not paying $100 for the business. You're actually paying about $264 billion for the business, which means you're paying about 8x their cash flows for the company. Now, sometimes what I like to do is I like to take their cash flow and divide it by their market cap. And that's also still pretty good. That's a 7.5% yield. That's not bad on sort of a free cash flow yield if they can keep this sort of annual cash flow going of 20 bill, $5 bill a quarter. Maybe they can't. And that's where the questions are, because if we just annualize out Q1, it doesn't look that bad. Yes, their balance sheet isn't that perfect, but it's not uncommon for insurers to operate a little tight, and they've got the free cash flow if we can annualize Q1. If we have to annualize Q1 of last year, it ain't that good, because they're only clearing like $1 to $2 billion in free cash flow. It's not as good. That said, the insurance business is a very low margin business. Their Optum, I guess it actually is. It's not Optimum, it's Optum. But anyway, their Optum services business, where they provide services for pharmaceuticals and to doctors and others, only has an operating margin of somewhere between 5.8 to 7.4%, depending on which quarter you're looking at. And the actual healthcare business only has margins of between 4% to 6.2%. It's a low margin business. They pay out a lot of money. And so it kind of makes sense that they go around and try to find whatever loopholes they can to milk as much money as possible out of the system. But this is where the fraud allegations are coming up, because they're doing things that are just wrong. And this leads people to say, why would you ever want to touch this business? Because a lot of people are looking at this as a buy the dip opportunity, but others are like, I just can't bring myself morally to invest in this business. That's what some say. Now, keep in mind, the CEO did just buy $25 million of stock and the CFO bought $5 million of stock. A lot of people see that as just signaling though, because you might not know this, but the CEO's stock package, $61 million. So it's kind of like he took a fraction of his entire pay and sort of like reinvested it back into the business to send a signal. And if you look at their income statement, they do pay out a lot of the premiums that they spend, which again contributes to these lower margins. They pay out about 84 to 85% of the premium dollars that they collect. So imagine you were an insurance company and you were collecting $100. You're paying out about $85 of that in premiums. It's kind of an interesting stat if you're ever thinking about insurance. And then they got a whole crap load of costs on top of that, obviously, because they have to deal with the government administration and people and all of the claims and underwriting and processing. It's dealing with the hospitals. It's kind of just a crap business. The margins are really, really low and their balance sheet is tight. Again, long term, they've got money, okay? And they produce cash flows. But it's a tight and dirty ship. Think about it like that. You know, it's not like they're selling iPhones at a 25% margin, right? Where they're bringing so much money down to the bottom line because they're selling you this beautiful app store wrapper as well. This is a tight and dirty ship. Now let's talk about the dirt. The Wall Street Journal did this like Pulitzer Prize winning expose on them. And I'm just going to give you the bottom line on this, okay? Let's say you're a health insurer and the government tells you, hey, you will get paid in lump sums for any Medicare Advantage patient you have that has a new diagnosis, okay? So imagine you're an insurance company and the government says, hey, if you insure those 10 people over there and they have no diagnoses, you get 0. But if each of them has 1 diagnosis, we'll give you $2,500 per person. If they have 2 diagnoses, we'll give you $5,000 a person. What incentive do you think that sloppy government assignment creates for United Health? Let's send nurses to every old person's home on Medicare Advantage for free house calls to see if you have any ailments. And that's exactly what they did. They hired nurses, sometimes to go to, conduct 6 house calls a day and basically hook up patients to random BS, diagnostic equipment to find out if the oxygen flow to your extremities, for example, like your big toe, is slightly below average, so we could diagnose you with some arcane illness that you don't even know you have no problems with. It's not like you're falling off your feet or whatever. You don't even realize you have a problem. But they're going to register that as a diagnosis so they can collect money from the government, meanwhile not actually pay anything for you. So the reports that the Wall Street Journal put out basically said for every house visit United Health made, they earned about $2,700 in revenue, $2,735. And they were the worst out of all of the different insurers. Humana at $1,525, CVS Aetna 300 or 232. Anyway, so you could see the desire to conduct a lot of home visits. United Health did the most and make lots of money off that. Now the cat's out of the bag and the federal government has said, look, we're not paying for some of these diagnoses anymore. You ripped off the system because now people have all these diagnoses that they didn't even know they had. Their doctors didn't even know they had. And they were never treated for, just so you can milk some free money. And so now, obviously, earnings for United Health are kind of in the toilet. They've withdrawn guidance because they're like, crap, we don't know how much of an impact this is going to have. All the good numbers we had were based on basically fraud. And now we got to pick up the pieces. So what pieces are left? Well, again, it's a business that on a free cash flow basis yields about 7.5%, on their market cap. So yeah, the dip is sizable. But again, you're getting into a legally fraught and now a hated business with terribly low margins. Look, is this a great buy the dip opportunity? For people who are just gonna put any kind of morality on the shelf? Maybe. But look, I stay out of the insurance sector because it's complicated enough as is. And looking at this United Health stuff, I'm like, man, I scratched the surface and I'm like, this is a disgusting business. I'll pick any other business. So look, if you buy the dip and you make money on it, I'm happy for you. But I can't touch this kind of business with a 10-foot pole. And again, I'm not telling you not to. I'm just saying for me, man, it's not my world. I'll go stick to houses. Which, speaking of which, I'm going to show you a before and after now of HouseHack. A lot of you have been wondering, what does HouseHack do? In this video, I'm going to show you exactly what HouseHack does. This is a fixer-upper. It is a single-family home. This is not actually the highest and best use for this property, for this lot. Spoiler, if you go back through this little Matterport over here, and you go to the backyard, you're going to see a property that actually has a really juiced backyard. If I can get back there. The graphics, the NVIDIA graphic card is shutting down because it's too much of a fixer. This is what happens when you buy too much of a fixer-upper. You can't even get the ray tracing and rendering to function. Anyway, let me just put it this way. Spoiler alert, this right here is magic. But we'll get back into the backyard in just a moment. HouseHack buys trash properties that are disgusting, okay? This place needed a whole new roof, It needed all these water leaks fixed. We had to tear all this crap out and redo it all. So you fix the roof, you kill the leak. Then you tear out all the crap that's nasty. Get rid of it all. Okay? This takes a lot of work. If anything, if it weren't for that backyard, which you're about to learn about, this is almost too much of a fixer-upper from what I like. I like paint, carpet, kitchens, bathrooms, okay? This is a lot. Somebody built a whole, like, guest office in the garage. A car literally drove through the damn property. This is the garage in the front. And it just, like, oops, I guess there goes the structural support for the header beam above the garage door because somebody drove into it. Now, obviously, that's all been repaired and replaced with structural hardware and quality products. But you go into the inside of this building, you've got old 1960s louvered windows, you've got water leaks, you've got holes from old skylights, trash coming down the fireplace. So you'll see the after in just a moment, but my point is, when people say like, hey, how does HouseHack make money? Because HouseHack pays to its non-accredited and accredited investors in our round, which we're raising at $1.40 a share, okay? Like, I want to IPO this sucker in a few years, and I want to take care of everybody. I can't make guarantees, but I want this to be a big IPO. I really am so excited about this business. I see it as my little Berkshire Hathaway. And so the reason we can pay out a 5% yield plus the upside in the stock, knock on wood, through conversion, is because we fix up places like this. We gain equity in these properties when we do that. So we buy them for one price, we spend money, and then we gain equity on the deals because obviously a house that's fixed up and remodeled is going to be worth a lot more than this, more than even we put into it, right? And then we collect yield from renting these properties out, and then we can accelerate that yield by developing the lots. More on that in just a moment. But I want you to see this kitchen, okay? Look how disgusting this is. And we tore out, like, I don't even like tearing out kitchen cabinets, but we tore out these kitchen cabinets. I'm like, yeah, no. I'm not putting anybody through this trash. Old countertops over here, hallway. I mean, I think you get the idea, okay? It's a nasty property, and it needed a lot of love, and we gave it to it. This is a lot of work, and to do it right is a lot of work. You got to stop the leaks, you got to redo the bathrooms. It's crazy. All right, so you get the idea. Let's now go to some of the afters, and then I'm going to tell you the magic of why we like getting involved, especially in properties like this. We don't do this for all of the projects because there's a limit, in my opinion, to how much exposure you want to development projects. Some things you just kind of want to, not develop and just rent out, and other ones are just really desirable development opportunities. This is the after of the garage. Look, it's a garage again. It's beautiful. This is the after of the inside area. Remember where those skylights were? We actually replaced the windows on this one. 2-inch faux wood, louvered blinds. The fireplace is beautiful again. New light fixtures, new flooring, baseboard, paint, drywall. All new kitchen cabinets, appliances. This is gorgeous. Like, this is a HouseHack property. This is the work that HouseHack does, and it's great. High quality. Look at this. Brand spanking new. Everything out, new, in. And it's a lot of work, but that's our job. That's what we do. So anyway, you get the idea, okay? That's what HouseHack does. Now, look at this beautiful yard, okay? This might take a couple years, but the magic sauce in a property like this, in a location where this is, high value location. Okay, it's by the beach, all right? Ish. Close enough. Pay the beach values. Is we can actually add 5 units to this property. Up to 5 units, TBD. Based on what our discussions are so far, and we have not submitted plans on it yet, we're just working on drawing the plans now. We could actually turn this one property from a 1-unit single family, which is fine, into a 6-unit property. Yeah, absolutely crazy. Hopefully we can get to the 6. Maybe we'll only be able to get to 5 total. But that in our opinion, significantly amplifies not only the value of the property, but the cash flow that we get, because when you develop, your yields on cash are usually a lot higher. You know, you could be somewhere between 6.5% to 10% ROIs on an ADU development. But beyond that, the value that you actually create for the lot explodes, because now you basically created a commercial 6-unit property that still finances under 1 to 4 real estate because of the way they count ADUs. It's kind of crazy. Who knows? Maybe they'll change that one day in the future. So you have that buyer liquidity should you turn around and want to go sell this in the future. And HouseHack wins. So that's what we do. It's a lot of work, and a lot of people don't understand what we do, and I think it's helpful to see this. So anyway, if you're interested in being a part of this and diversifying to these sort of efforts, go to househack.com. You can invest in the non-accredited round. You do not have to be an accredited investor. You get 5% on an annual basis paid to you monthly. Obviously, it's a startup. There's risk with every single investment. But this is the stuff we do, and if you want to be involved in it, go check it out over at househack.com. Thank you so much for watching this video, and this is just one example, one property that we've worked on here, and I think it could be a multi-million-dollar ROI for the HouseHack business, and it also creates this reputation of us as a developer, which also has multiples on the stock market that I think are very desirable. Anyway, more on that in the future. Obviously, again, risk with every investment. I'm the CEO, so I'm a little biased. But I'm very, very excited about this company, okay? So this is why when people are like, Kevin, but what about the stock market? I'm like, stock market's cool. I like what I'm building. Anyway, thanks so much for watching. We'll see you in the next one. Goodbye and good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.